Welcome to the panel session on how to fuel fintech growth. I'm very delighted to have an illustrious collection of panelists here on entrepreneurs and founders and CEOs who are going to be talking about growth in a few different contexts. We're going to talk about it in the context of raising capital. We're going to talk it in the context of how to win more customers. We're going to talk about going into new markets with new products. So growth in many different guises. I just wanted to begin, if I may, with just some stats when it comes to the capital side. And 2018 was a really nice bounce back year for European fintech. Venture capitalists invested about $1.4 billion in the first 3 quarters, and that was already greater than all of 2017 or 2016. And technology IPOs in general, not just fintech IPOs, in Europe raised 3.3 billion euros, and that's a 74% jump from 2017. So that was a really nice bounce back year. I thought we'd begin with initial public offerings, and I'm pleased to have Stéphane Boujnah, who is the CEO of Euronext, the exchange. Perhaps, Stéphane, you could get us kicked off on what is the picture for 2019 when it comes to initial public offerings. We had a good year last year, but there's always grumblings in I hear it in the tech community that maybe IPOs are too much hassle, it's too much trouble to kind of do them.
Well, two comments. Number one, 19 starts with a good pipeline, but 18 was also starting with a great pipeline, and there were many delayed or canceled deals. And there are two reasons why deals are canceled. The first one is that now everyone goes into a dual track process, and that with the magnitude reached by the PE world, you can have a valuation with a premium from a PE, which sometimes sounds more attractive if you are in take the money and run than the IPO valuation, which has a discount associated to it. So the first thing is that the competition of the PE stage before going public is now becoming recurrent, and that's the first source of cancellation. The other one is that something funny or very impressive happened in the markets last year, which is that most of the stress and the anxiety and the uncertainty of markets focused on IPOs, not really on blue chips. Up until November, December, the blue chip worlds, the main indices were cool. But since the beginning of the year, we had pressure on valuation at IPO levels. So when you combine market pressure, the fact that the market basically for almost 10 months said, China, trade war, global tensions, Italy, Brexit, we don't care. Now, but for IPOs, they did care about much more small things. So there was a binary allocation of risk appetite between blue chips. So when you combine that with the secular trend about PE, you have a different one. Now, it's true that for 19, we still have the same logic. So the first part, which is whether people prefer to sell with a premium to a trade sale, an M&A transaction, or to go public, really, at the end of the day, it's about entrepreneurs and boards. I mean, either you believe that the worst is behind you and that the best is ahead of you, then you should definitely go for an IPO to capture most of the best. Or you believe that the best is behind you and the worst is coming, then you should find someone to sell with a premium. But it's a matter of how confident you are to transform an industry, whether you have done a nice coup and build a proof of concept, burn a lot of cash, you look smart and slim and happy, and find someone who buys your dream and you run away. Or you believe that you have really invented something and you do what Zuckerberg did when he got an offer to sell his company for $1 billion. And as I said on many occasions, I mean, the fascinating story is not that Zuckerberg believed that he should ignore and push back a $1 billion offer, is that he found a board of 10 or 12 people who are in the business of making capital gains, who said, you know what, we should ignore that and go public. So I think the pipeline is exciting, but with those two mitigants. But what we are trying to do within Euronext is precisely to be the home sweet home for all the ones who want a machine to print money, i.e. a public stock, who want a tool to incentivize their managers with the liquid instruments, who want to accept the discipline of being different, because you have to be reasonable. The old good days of burning cash and having champagne days for signing clients are over. You need to deliver numbers, which is different, which is how you create value. For the ones who want to transform their industry, the stock exchange is the home sweet home, and that's why in the fintech world in particular, we have welcomed Adyen at the beginning of the year, and it's now a 20 billion company, and we try to build a fintech sector in Amsterdam.
Is it harder today to do an IPO than it was, say, 3, 4, 5 years ago?
No.
Is there a more regulatory hurdles now? Or?
It's not harder. It's that there are alternatives that exist. In the old good days, you were building a company, and when you were reaching to a point where you had either or, a big pressure for liquidity from the incumbent shareholders who needed to rotate their assets, and or a need to go back to the pump to raise own funds, then there was only one option, which was the public markets. Now the difference is that you have guys who metabolize the central bank's liquidity that was swamped the floor. So they take money, they metabolize debt into equity through private equity process, and then inject that, and hence the high valuations and the availability, which is fine. But now it's not more complicated. There are more alternatives. Every market has now an entry market. We have Euronext access. Everyone has lowered the bars, or everyone has learned the lessons of the difficulties of the Nouveau Marché, Neumarkt, and the AIM issues. So I think it's not more complicated. It's just that there are more alternatives.
Yeah. One of those alternatives, of course, is equity crowdfunding, which has been just what a story over the last decade. And we saw that in December, Monzo, the British digital bank, raised £20 million in just 2 days in a crowdfunding round. And Jeff, you're one of the founders of Seedrs in the UK, one of the pioneers of equity crowdfunding. Was the Monzo raise a game changer?
Well, so I think the way to answer that question, I will answer it directly in a second, but I think the important thing is to see equity crowdfunding in the context that Stefan was just talking about, which is the vast number of new players and the vast number of additional capital, vast amount of additional capital that is now looking to invest in private growth companies. I mean, there was a time when it really was limited to a number, and I mean this in the fintech space, but I mean it more broadly in the tech-enabled space. There was a time when the players who were willing to invest on a private basis were really limited to a handful of fairly specialist VC and at larger stages private equity firms. And what we're beginning to see now is everyone from retail to intermediaries, family offices, institutions, and others interested in coming into this space, not eschewing the public markets. Public markets still obviously very important to them, but willing to allocate increasing portions of their investable capital or increasing portions of their AUM into private growth-focused companies. And what's really interesting, I mean, that's great, I think, for this tech space generally. The supply of capital has, I think, helped feed and fuel the growth of many sectors, fintech included. But what's really great to us and what we think is so exciting from a crowdfunding perspective is that crowdfunding isn't and never was intended to be just retail. I think it often gets that perception, and a large part of what we do is about helping companies raise capital from their communities, from individual retail investors. But really, crowdfunding is about providing a platform, providing an infrastructure through which all types of different investors can come in and invest in private companies at all sorts of different stages. And so as more and more types of investors want to come into this space, more and more businesses see platforms like Seedrs as an opportunity to raise capital, the entire ecosystem grows very significantly. So now to Monzo in particular, look, I think it was thrilling. I mean, Monzo, a couple things were really thrilling about. One is that they largely did it on their own, which was really interesting. You know, we were talking backstage about Brewdog, which really pioneered crowdfunding kind of on its own in early days. Monzo did a sort of variation of that, and that's maybe a little scary for those of us who run platforms norms, but it was a great innovation. But I think more to the point is that what we saw in the Monzo round was less a game changer than an evolution of something that we've seen happening. We've seen businesses like Revolut and Bucks, who's speaking here, and others, raised through Seedrs, doing bigger and bigger rounds, faster and faster rounds. So even as maybe some of the hype dies down, and you don't see it as publicly anymore, that growth has been continuing, and Monzo's one more sort of way station on the road. So very exciting to us, but less of a watershed than sort of a step in an evolution.
I say one of the elements of the crowdfunding proposition that Seedrs works in that I think is very fascinating is it's not just about raising capital, but it creates this kind of relationship with the customer. So if you participate in a crowdfunding round, you're not just giving money, but you're kind of joining the club of that particular company. And I think that's a nice segue into how important it is, the customer relationship. Somebody earlier this morning was saying, fintech, saying to me, like, fintech, actually, the tech is not that important. I mean, it is important, but it's not that important. But it's really all about customer, customer, customer. And Jaydev, at Zopa, you're the CEO of Zopa, and Zopa's, was it 2005? So primordial fintech in the UK. You've actually drawn from a lot of old school methods to build your customer base, point of sale, the work that you're doing with auto finance and making sure that the seller of automobiles can offer a Zopa product. Kind of walk us through how you've developed that and how that's helped feed your growth.
Yeah. So at Zopa, we were we were the first peer-to-peer lender in the world, and in that sense, could claim to actually inventing the idea of crowdfunding debt, not equity. That's a fantastic business, and kind of takes effectively into account the trend that we're seeing, that people want to actually diversify their investments, and there were investments earlier that only big companies or funds needed to do, and now individuals want to do that. And Zopa Seedrs was a way for individuals to actually access those assets and kind of diversify their portfolio. But what has been the fundamental ethos for Zopa has been really understanding customer need and working backwards from there. And we've always thought of tech as a huge enabler of delivering that customer need in a way that's cheap, that's efficient, but actually that creates customer delight. So let's talk about the example of auto finance business. So when we look at the auto finance business in the UK, if you end up buying a used car, we saw that you typically end up paying a lot more for your loan than actually taking an unsecured loan from us. And that didn't kind of compute. It didn't compute because when you're taking a car with loan with a car as security, it should be cheaper. And what we found was in the value chain, there was a lot of inefficiency. The cost of capital for a lot of the players was very high, and thus they needed to pass that on. But B, there was a lot of commissions that were paid to intermediaries. Very high commission rates of the order of 6-7% per loan, versus in the unsecured market that was more like 1%. And all this cost was being borne by the customer. And we figured there was a way to make this work better. And when we spoke to the intermediaries, and again thought of them as our customers, they talked about why they have to charge very high commission is because the costs for them are very high. The lenders have typically manual processes where faxes were sent back and forth before they could find whether a person was approved or not. There was a huge amount of wastage because people would come, their loans might or might not get approved, thus they want to buy a car, but then somebody else buys that car. So there was a huge amount of inefficiency, which was not great for the intermediaries and not great for the customers. So we used tech to address that. And what we said to the intermediaries was give a very simple proposition, which said, within 10 seconds, we will tell you whether we will give a loan or not. And when we say yes, you'll have the money with you the same day. Even if it's a Saturday or a Sunday, we'd make that happen, right? And that was us thinking of the intermediary as a customer and saying, how do we deliver that? And in return, what we said was we wanted first look at all the customers, because we were only going to take 10 seconds and it was not going to waste any time for the intermediaries. Thus, we could see.
So you told the dealers you want first look at the loan.
Yeah,
okay.
And what that meant is that we could actually get a positively selecting group of customers coming back, which allowed us to price very competitively. It also meant for the end customer who was buying a cheaper loan, because we were actually in return paying them lower commissions to the intermediaries for a far better service. And the intermediaries are happy to do that. And in fact, they are facing increasingly regulatory pressure to kind of do better for the customer. And this proposition worked as end-to-end. So it was really using technology, which was an important part of the proposition, as a way of understanding the customer problem. The customer could be the end customer, the customer could be intermediary, and making that better. And that's what actually has worked for Zopa.
So what you were addressing was a long-standing practice in a very old business.
Indeed.
Okay.
But using technology to actually really disrupt that.
I see, okay. Laurent, your growth picture, the growth story at your firm is one very much about markets, the markets that you've chosen to go into. PayU, and perhaps you could share with the audience a little bit about what it is that your company does, but you've focused on Central and Eastern Europe, and of course in India. How did you come to decide to choose those markets?
Yeah, I sound very French, right? So can't fake it too much. But we've got a different take, really, on growth and fintech growth. First, because we're part of a group called Naspers, right? So 100-year-old history, from South Africa. Very fascinating animal, right? Operating businesses and making large bets in technology. One of the biggest bets was Tencent 10 years ago, right? So we're still living very well out of that bet. We do a lot of different businesses. My job is really to look around fintech opportunities around the world. And yes, indeed, the one thing where we focus is, call it growth markets, developing markets. We are really looking after the 3 billion people, right? From India, Africa, Central Eastern Europe, for that matter, and all of Latin America. And what does fintech mean there? So, I'm based in Dubai. I spend a lot of time in India. How do you, approach fintech growth in the fastest growing economy in the world, which is India right now? So, a few things just to pick up on what my colleagues have said. The first one is, well, technology does matter, only combined with the right data. So for us, we started, PayU is a payments business. Which is, plain vanilla, not to say boring. You just process payments. The value there is truly in a market where the credit bureau are just targeting the 1% of the population, where all the big US companies talk about financial inclusion, yet have done nothing for the billion people there, right? How you can use this payment data to really create something new, which is access to credit, for instance, right? So that's one. Technology combined to data. That's something that gives you an advantage and really creates the growth. The second thing is, it's not just about money, right? In these markets, you have access to so much money from Chinese investors, for instance, right? That indeed, going public sometimes is not even, part of the equation. So why should I do that, right? I don't need to justify anything. For me, it's not just access to this. It's when you start building a financial services business, especially in credit, you also need to think about how you're going to structure your balance sheet at depth. And that one is something that sometimes in these markets you don't find. So that's another element for us of differentiation. And the third one, yes, indeed, it's about consumers. But for us, what it means is, I think the Chinese example and also what you see in India is how you can plug yourself into these huge consumer platforms, which you wouldn't think of. Like, for us, we did 1 million loans in December, 1 million loans, just through an app doing food delivery. These are huge consumer platforms. Take WeChat, right? Take Paytm, for instance, right? These are huge consumer platforms that are starting with one use case, ride sharing, food delivery or other stuff, building a huge user base, and then you plug into that one your consumer financial services, for instance, and then you get to digital banking. So for us, if we step back, if we see these three elements, and then we compare, the fintech startups in continental Europe, for instance, that's where we put our money, in these complicated, far-fetched markets, but that's where we see most of the growth for the next 10 years.
Actually, just to kind of add, I think you make a very good point, which is very consistent with the way we think about it. We think of a different trifecta, which is technology you talked about, customer problem, really understanding and meeting good customer needs. And the third is about data, right? So the reason we are able to instantly approve someone is because we've been operating for 13 years. We've got millions of customers and their credit bureau and credit data, which we can use to create more sophisticated models that allows us, without manual intervention, to make instant decisions very, very quickly. Without that data, anybody can lend money. The idea is about getting it back. There wouldn't have been much guarantee in getting that back. And having that trifecta is important. And unlike markets like India, where you actually have to work hard to get some of that data, like in the UK, I think if given the credit bureau where we are going with PSD2 and open banking, I think more and more of that access of data will be available to fintechs like us, which means I think the opportunity for us to grow, if you can combine those three things together to create meaningful customer value, is humongous.
Okay. Stefan?
Just maybe one word that was not mentioned so far. That's probably is a key concept between the private world and the public world. That's the word regulation. When you create a fintech company, like any tech company, it's all about being disruptive, innovative, different. When you go to public market, you are benchmarked against other investment opportunities. So it's all about being growing, profitable, resilient, and strong. Now, the fintech world is all about technology. It's all about marketing. It's all about data, which is at the junction between sales and technology. But money is a public good. So money is regulated unless you remain small. When you are small, you can find niches where your business is not regulated. When it gets big, someone has to pay the bill if something goes wrong, and then regulation jumps in, and the bigger you are, the more captured you are by regulation. So I believe that one of the key differentiator between remaining private and doing your own cooking versus going public, obviously private companies are as regulated as large ones, but there is a big difference in terms of visibility in the radar screen and attention by regulators to the public world. And that, I think that's something that is sometimes massively underestimated, because the skills you need to invent something different, something disruptive, something innovative are different from the skills you need to build something robust, boringly sustainable, and compliant. And that's one element. It's something you can live with, a sort of regulation ambivalence or ambiguity when you are private. It's all about look at how great my technology is and look at how intense and deep my data are. When you get public, you have to take the compliance box pretty seriously, because the money of too many people is at stake.
Well, I wanted to just bring up the Adyen IPO, just while we were talking about that point. The Adyen IPO, Adyen is the Dutch payment processor that it's returned about 164% since the IPO last June. And do you think the management of data, how did data play a role in the way investors saw that stock? Anybody kind of jump in? What do you think?
I mean, they are clients, so I'm happy to sing songs about them. It's where they are either competitors or it's generating envy for the others. I mean, it's a great company, 20 billion a year. One thing is very important. This company was very mature and well developed long before they went public.
It was profitable for
which
years.
Which is something very interesting. The big difference between the first internet bubble, when some of us were already around when we were young and slim, is that at that time any company was getting public in 4 years between, any successful company. Today it's more 6, 8, etc. For the reason I mentioned earlier about the availability of private capital, also because a dream that I've not covered here is the consolidation by large insurance or banks, which is offering a third way. In every large international bank or large insurance companies, you have people whose whole business is about buying fintechs. I buy a fintech, hence I work. So because then when you are in a panic mode about digitalization, you say, well, doing things organically is scary. Doing in a partnership mode is painful. Let's buy them. And that's the third way. So that's why what Adyen did, which is really amazing, is that they had a strong view that they were going to be a market leader to transform the payment, and that someone will have to capture the bubble of Netflix and all the other global players who need payment support. And I think they did an amazing job in a very consistent way with a solid corporate culture.
Jada, if you wanted to, just to go back to your point on the regulatory piece, though.
Oh, yeah. I was going to go back on that. So I think while I agree with some of the spirit of what you were saying, I think I do disagree on a couple of places there. So one is, I think you made a statement that fintech is all about disruption and breaking, and I think that is possibly true for some firms, but there are firms out there like us who have actually proactively sought regulation. When we started Life as a peer-to-peer company, we in fact lobbied with two of our peers to actually get the sector regulated. Once it was regulated, we were the first of the major platforms to actually be fully authorized by the FCA, which is the conduct regulator in the UK. Not satisfied with that, back in 2016, we started on our journey to get a banking license. And now today have a banking license that are jointly regulated by both the PRA and the FCA. And, knowing a little bit about being public and knowing a lot more about getting a banking license, I do feel that the scrutiny of the regulation is not that much different between those two. So I do think that while there are among the fintech players companies that that somehow want to live in that regulatory ambiguity, we do not believe that you can create sustainable value by being there. And in fact, it's better to invite regulatory scrutiny, understand their concerns early enough while you're building the company, and making sure that you create something that is actually regulation-proof.
Jeff, you did the
and
same
that's a journey
thing,
we
right?
did.
Yeah, I mean, as a recovering lawyer, regulation's always a favorite topic, and I would echo and amplify Jadev's comments a bit. I mean, I think one thing that's important is we're talking about there are two different types of regulations. There's regulation of the company in the way it offers its securities, either into the public markets or private markets, and then as a fintech, there's the regulation of the operating business. I think one thing that's often misunderstood about fintechs is in that latter category, we are by and large heavily regulated. We either, like Seedrs, were forced to be regulated before we were ever able to launch, or like Zopa, wanted to be regulated and had to go to the regulator and force policymakers to create a regulatory framework. I think regulation is in many ways our friend. It's got to be balanced. It's got to be right. But I think often there's an assumption we're all operating in some sort of Wild West. The vast majority, whether it's in alternative finance like debt or equity, whether it's in payments, whether it's elsewhere, is regulated. I think where Stefan is right, though, is that, yes, when it comes to how we raise capital as businesses, the public markets require a significant amount more disclosure, transparency, and a number of other things around the model. And does that always work as well for a company that's trying to be disruptive, that's trying to innovate, that's trying to keep things a little closer to the vest? And the answer is probably not. And so it becomes, and I think this is one of the beauties of the kind of duality of the private and public markets, is it becomes a market choice. If, investors can decide whether they want the additional protections that come from a public company, but have to acknowledge that that then means it's going to be a more robust but boring business, or are they willing to take the risk on newer, earlier stage, more disruptive businesses without all of the information? And as long as investors can choose which direction to allocate their capital in, I don't think one is better than the other.
Let's bring venture capital into the picture now. Are VCs more patient today in waiting for their exits than they were, say, 4 or 5 years ago?
Well, just one observation on that. I think one exciting thing that we've seen in the VC market in the last couple of years is an increasing trend toward use of permanent capital listed vehicles in place of GP/LP structures. And again, that may sound like boring legalese to some, but one of the challenges for VCs with patience through the years is it's not like the venture capitalists themselves were all that anxious. It's just that they set up these limited partnership structures that had to be paid back or wound down in 7 years, sometimes 10 years. And so there was a natural sunset. Permanent capital vehicles, which Woodford has done, Augmentum Fintech has done, a number of others, Draper Esprit has done in the UK, and others, by their nature, because they're tradable, they never actually have a payback period, and they're capable of being significantly more patient. So I think that's been an exciting trend. Whether it's just whether the few that we've seen are the tip of the iceberg or an anomaly, I think is to be determined. But big fans of listed permanent capital vehicles.
What about growth capital? Does Europe still lack when it comes to growth capital funds, the growth capital ecosystem? Is that still kind of a deficiency in the European ecosystem compared with, say, the US? Like late-stage growth capital?
Well, frankly, yes, you hear these sort of things, but the reality is that the same people start thinking there is not enough growth capital, and they complain about excessive valuation. Now, you have to reconcile things. If the valuations go to the roof, that's probably because there is enough money. And I don't know many projects with a sound business plan, with a solid management, who is now desperate about finding a funding gap. I mean, we tend to see the opposite. And I believe that what we observe is precisely what I mentioned earlier. There is a huge growth of the pre-IPO market. Now, I know that in France for several specific segments, but let's not confuse everything, because people talk about the tech world and they confuse very capital-intensive companies like biotech, where there is an issue here. And even if we have fixed it, I think to a large extent with Euronext, where we have a solid biotech segment now. But if you put aside some very capex-intensive sectors where there might be an issue, for the fintech world, I don't think it's the case. But I may be wrong because I'm too close to the public markets.
Well, look, I think the money is definitely there, right? If you look at the latest big rounds, especially around digital banking, right? Money has come from different places around the world. So I don't think it's a problem of availability of growth capital in Europe. It just will bring us more opportunities to really fund companies that have truly a global, strategy and ambition, and not just be number one in France or number one in the UK, which for us is, at the end of the day, is like, well, that's not so relevant over the next 10 years, because the corollary of having this growth capital is indeed the time horizon has changed, of course, right? You do have people willing to hold, for 10 years, and you've seen that very easily, in many, especially fintech investments. I think I wouldn't blame it on the lack of availability of capital. It's more like, show us a business that has truly scaled across, borders, show us the global ambition. And look, I must say, sometimes it's lacking here also.
I think one place where there still is opportunity for expansion in terms of growth capital, I think it's gotten a lot better, and I think part of the reason it's gotten a lot better is, the infrastructure was laid. I mean, 10, 15 years ago, there wasn't much seed and early stage, venture capital in Europe. As that's grown, you've had more businesses grow, which means more people come into the growth sector. But I think where there still is a big opportunity, and we see in the US, this having succeeded in many ways, is getting significantly larger institutional investors, pension funds, university endowments, and others beginning to think about venture and private equity as being part of their portfolio mix. And I think culturally, there's still something of an aversion to that on this side of the pond. And I think if we can begin to move away from that, begin to get, look, it's never going to be a substantial portion of their portfolio, but 5, 10% of the portfolio into these kinds of alternatives, I think that will unleash even more growth.
I think capital, to your point, is not a problem, but the capital, particularly growth capital, rarely tends to be European. If you look at some of the big rounds that are done, they're often either led by the US or sovereign wealth funds from Asia. So I think capital is available for European companies, so I don't think that's a constraint. There is a question mark that why aren't there more kind of traditional, and maybe it's what Jeff's saying here, it's maybe something cultural, that why isn't more European money itself going into European companies, where I think there's probably less.
Just the appetite for risk capital on the part of institutions that we see in the US, we still haven't really seen that develop in Europe the way you'd like to. Is that your point?
But for the right asset, they will find money. You go to Singapore, you will find money there. For the right asset, they will find money. It's like, look, it's truly a global one.
I think that's I think we're all sort of in agreement. It's not that European companies are having trouble getting funded at this level. It's that they're just not getting funded by European investors.
I see. So what is the upshot of that? What's the downside of that?
Well, I think two things. I think one is that I think it's very difficult to say that every business that should be getting funded is getting funded, because it's one of these proving a negative type things. I think there are almost certainly vast numbers of businesses that we're not hearing about, not seeing, that really could, with somebody taking a bit of a risk on them, could potentially have grown, and more capital would help fund that. I also think there's probably a little harder to define, but probably a geopolitical sort of dimension. If you have significant amounts of capital coming from the US and coming from Asia, that's going to pull the commercial operations and ultimately pull sort of the M&A activity of the business into those markets. And Europe is famous for its small exits. The venture capital has been a great asset class, but it's constantly, as a result of 100 million, 200 million, 300 million euro, pound, etc., exits, because new investors come in and the center of gravity winds up shifting. Can we start building real sort of decacorn plus champions in Europe? I think having local capital driving some of that would be a very important component of it.
I'd like to ask our entrepreneurs on stage right now just what plans you can share for your own companies in terms of growth going forward. I mean, you've just got your banking license in December, so you're still kind of test driving that. But Jade, if I'll start with you, I mean, what is the strategic growth plan for Zopa over the next 2 or 3 years? And can you share with us whether eventually that IPO might be there or something else?
Yeah, so I think I agree with what's being said here, that the long-term destination for really successful companies is a public market exit, right? So, because I think that in the end gives you the right level of access for capital. And when you are in banking, unlike peer-to-peer, banking is a capital-intensive business. We have huge ambitions. We have line of sight to growing our balance sheet very rapidly, and that means we'll be looking for kind of more and more regulatory capital. Thus, we do see that the natural destination for companies like us and ours would be a public market exit. What's so fantastic is that as we see the market right now, there are other options available, and it's always good to have alternatives. So we will be looking to probably do another private raise over the next year or so to make sure that the bank, which we are test driving right now, as you correctly said, is launched. We actually launched the credit card product and the deposit product that's going to go behind that. And once that's in market and operating really well and growing, probably for the next stage of regulatory capital, we go to the public markets. But I think we feel reassured, given the depth of the private markets here. We think that's a luxury that entrepreneurs 5, 7, 10 years ago didn't have, and it's fantastic to be in that position.
Right. I think for us, for the next 3 years, really, the plan is I hope, clear but not simple. But the first one is really how do you build the #1 payments company for all the developing markets, which for us means expansion into Asia, Southeast Asia, which is truly right now a very interesting market. I mean, collection of markets. And the second thing is actually act as the consolidator of all the smaller payments companies that we see around the world. I mean, payments is scale and efficiency, and you can just basically, buy all of these assets.
Are you talking about acquisitions then?
Absolutely. I mean, that one is full buyout. You integrate into your platform and you scale. That's for payments, which then for me feeds into credit. And the focus for us is to build the #1, alternative lender, right? The Zopa, of India. That's the #1, that's the #1 goal, which requires access to data, distribution, and balance sheet, because that's a balance sheet business, right? Don't plan to become a bank. Don't plan to go public. I feel your pain. But the third one is once you've done 1 and 2, from payments to credit, is to go into digital banking, because that's the sense of history. And I think here we've seen very good examples coming out of Europe. I really cheer for them, going into the US, because I think that's really the one opportunity we have to make it big there. I think, again, when it comes to India and Southeast Asia, it's going to require a different models, because there you have huge consumer platforms. 10 years from now, maybe there will be one European payments company, I think. It will be US or Asia. We want to be one of them, yeah.
So your strategy looks like is initially acquisitions through the market that you're serving in Southeast Asia, incorporating both credit data, platforms, et cetera. And then eventually you want to do more lending in those markets, build up share, accumulate more data, build new products off of that, and eventually you'd be a digital bank at that point. Okay.
Yeah, that's the grand plan. It looks good on the slide, then it's all about execution, right?
Okay, Jeff?
So we've got a lot of really exciting growth opportunities ahead of us over the next few years, and one of our big challenges is prioritization. But 2 of the big ones that we're particularly focused on are, one, building out products and capacities to help serve institutional and quasi-institutional investors better. As I said before, we are increasingly seeing ourselves as a marketplace and seeing demand from investors that are not your typical traditional retail investor who wants to click on a pitch video. They want access to our deal flow. They want to build portfolios, but in different ways. So this month we launched our first fund product, and it is what we think to be the first true tracker fund in venture capital, in the sense that it's going to invest across 100 deals on the platform that meet certain specified criteria, but giving very broad-based exposure. We've also launched an auto-invest feature that allows people to build customized algorithmic portfolios. And there's a whole lot more to come in that space as we continue to build out the proposition for institutional and quasi-institutional investors.
So the tracker is just for institutions?
No, retail are welcome
kind
to
of
it
tailored
too.
for...
Yeah, and actually the first one, because it's an EIS fund, is actually largely for intermediaries to pass on to their clients, but we'll have other versions of it as well. So it's a mix of propositions targeting different types of investors. And then the second big bit of our sort of growth strategy is around Europe. And I hate to do this, Ed, but we've gotten to within 1 minute of the end without bringing up the B word, but I'm going to bring up the B word. Post-Brexit, we actually see the pan-European opportunity as bigger rather than less, and we are very keen. We plan to dual headquarter in a remaining member state, probably within the next year. It's a very exciting piece of legislation going through in Brussels that will harmonize regulation around what we do across the remaining EU. The UK still remains a very important market to us, but the European play is key, and we think becomes even more exciting and more important in a post-Brexit world. Final thing I'll quickly say is, with all of this, I think, these next few years and the growth we want to drive, we can do while remaining a private company, and will do. And frankly, we are at that stage where the public market isn't going to value us the way we'd like to. We like our 20x revenue valuation. I don't think we're going to get that from Euronext. We've got to get to a stage and a scale and a level of profitability where that works. But I think that, in the future, we're very much open to IPOing. And I think my final comment, I appreciate we're out of time, is that, I think one of the things about fintechs being regulated businesses, at their core, is that I think we're largely less scared of the public markets than some tech companies. A typical Facebook social media type player that really was moving fast and breaking things and had no compliance infrastructure. The cultural change to become a public company was massive. We've been a lawyer-heavy company, and people like me, since day one. And when the time comes and when the economics are right, we'd love to IPO and be part of the public markets.
Stefan?
Oh. I'm not an entrepreneur. I run a business that was created 300 years ago.
But entrepreneurs are your customers. They come to...
No, but actually we are under pressure, like we're under competitive pressure. We have innovation challenges, technology challenges, rating challenges, etc. Like any company, we have tripled the market cap of the organizations over the past 4 years, and that requires hard work and agility that, like any other enterprise. No, our objective is to remain relevant as long as possible, and to adjust our business models to remain relevant, to be the place where people raise capital when they cannot raise debt, and to be the place where you finance long-term when you finance risk, and to play our role in the food chain of funding projects. And that's a critical role in a world that is changing big time, but which is heavily dominated by, as I said, by regulation. So as far as the company is concerned, we have two objectives: diversify our top line to create more and more added value services, because if you don't provide to issuers corporate services on the top of the subscription fee just to be connected to the liquidity pool, then you become irrelevant. To provide to investors, to the buy side, more added value services. Otherwise, you become just a Me Too in this industry. And we need to differentiate ourselves against the Ubers of our industry, because I have my Ubers, and they are the MTFs of the world. And the second part of the objective is to build the backbone of the capital market union, to power pan-European capital markets to finance the real economy in Europe, hence the geographical diversification with, for example, the acquisition of the Irish Stock Exchange, which we've completed last year, or the ongoing dialogue we have with the Oslo Børs in Norway to offer them to join the family of the Euronext exchanges. So these are the type of things we need to do to create scale. So what we try to do is to create scale where scale is paramount, liquidity and technology, while keeping the local identity of each market, in particular some form of de facto specialization by sector. In reality, when you have ADN and a few other fintech in Amsterdam, then you aggregate around that a community of analysts that write about those companies. So you create a sector, you create comparables, and people list there, but they are connected to the full liquidity pool of Euronext. In Paris, you have a lot, for all sorts of historical reasons, biotech and medtech. There is an analyst community that write about this company. There is sector, there are comparables. So tomorrow in Norway, we will continue to boost, if we are successful in this transaction, fish pool and seafood companies from all over the world listing there, etc. So being united in diversity is the core of our ambition.
Excellent. Well, you have a lot on your plate.
Yes.
Very good, very good. Well, listen, please join me in thanking our guests and talking about how to grow fintechs, how to fuel that growth. Stefan, Jeff, Laurent, and Jadif.